Tomorrow. He's in Chicago.
Yes.
But with his great affiliation north to Green Bay, David Herro joins us, portfolio manager, beleaguered on the international front. David, let's do the baseball right away here. Brewers traded away their star to the Baltimore Orioles, you know, contracts and all that stuff. Do the Brewers have a chance to redo it again?
Of course they do, Tom. Now, we also traded away our manager to the Cubbies.
What was that about?
Which, I don't know. You know what, it was a good opportunity for Mr. Counsel. But the Brewers are on the ascent, the Packers are on the ascent, Badger basketball, all is looking good in Wisconsin.
Right, we won't mention the Boiler Up. They took it to the Wisconsin Badgers here the other day. Let's talk about the challenges of international investing. I'm not going to mince words, David, and I want to make clear, folks, David Herro and I go back ages and ages. Boy, it's been a challenge for you. When does your bet on European banking work out? What's the catalyst to create value in European banking?
Well, actually, the stocks have started performing over the last couple of years, and we've been overweight literally since the European sovereign debt crisis of, what was that, 2011, 2012, 2013. Recall back then there was a belief that the pigs were all going to default. Portugal, Italy, Spain, Greece were all going to, maybe even France was going to default. And none of this really happened. But during the better part of that decade, the banks did have to build capital like they did all over the world. And that kind of prevented some growth and more money going to shareholders. They still performed okay in terms of business operations. Now here we are, 10, 12 years later, we see banks that are fully capitalized, meaning that whatever they generate in profits, they could either use to grow their businesses or they could use to give money back to the shareholders. And that's exactly what's been happening. And at the same time, what we see is now with higher interest rates, don't forget Europe had negative nominal, not real, Europe had negative nominal interest rates. And today we're well into the threes. So I think all those things that were headwinds for the European banking sector are now tailwinds, which means that when we see these 6-7 times price to earnings ratio, 60 to 70% price to book, 9-10% dividend yields, this is in an environment where earnings are growing and where capital is being generated and shareholder returns are increasing. So I do think still, now we're about equal weight, we're not as overweight as we were because we trimmed a little into the strength. But I still think this is one of the great pockets of value if you believe that a business is worth the cash flow streams which they generate.
And David, give us your sense of the underlying European economic outlook here, because a lot of folks, they recognize the value in European equities and debt and just asset values, but just not sure about the growth over the next several years. How do you think about that?
Well, first of all, you have to look at Europe on whole, where you have various countries growing at different rates. Southern Europe, believe it or not, is doing pretty good. Spain, Portugal, even Italy growing 1%, 2%, 3%. Then, of course, the biggest economy in Europe, Germany, is on its back. It's on its back as it was a couple decades ago. And it's on its back for a number of reasons, starting probably with their energy policy. But anyway, you have this situation where people are judging European businesses by where they're based, not by where they're making money, not where they're doing business, not where their cash flow streams come from. So people don't want to invest, say, in a German company, even though a business like SAP, Siemens, Allianz, of course, Mercedes, BMW, these are global businesses that do business all over the world, that are growing, that have good return structures, that are selling at very, very depressed valuations. I believe the DAX is at just 10 or 11 times earnings. And when you compare this to the German 10-year, where is it about 2.25? So if you look at that earnings yield of the DAX, about 10%, and you look at the German 10-year, that yield, equity yield is about 7.75%. If you do that for the United States, you get about 20 or 30 basis points. And it shows you the valuation differential that exists in places like Germany versus the US. And I would argue it's unwarranted, given that many of these companies in particular don't just do business in Germany or in Europe. They're global businesses that do commerce all over the world.
So, David, let's switch gears a little bit and talk a little bit about Japan. I mean, when I started my career on Wall Street in the mid-'80s, it was you had to do a tour of duty in Tokyo. That was how important that market was. Boy, that's not been the case for the last 25 years or so, but I'm starting to hear more and more people, including Warren Buffett, talk about opportunities in Japan. How do you guys look at that market?
Well, like you, I started my career in the mid-'80s. 1986, I started my
Me too.
career.
June 16th.
Warren Spahn was on his final.
Well, how come I'm 45 and you're...
No.
No. I started my career in 86. International investing. My first fund I invested in was started in 1987, Des Moines, Iowa, at what was then called the Banker's Life. I believe Japan was somewhere around 75% of the international, of the IFA index. And it traded at about 60 or 70 times earnings, at 5 times book value, and it had an average return on equity, this is important, of around 7 or 8%. The market then peaked in 1989. Remember, there was a huge bubble, a property bubble, equity market bubble in Japan. It peaked at the end of December in 1989. The Nikkei was almost 40,000, just under 40,000, at 70 times earnings, 5 times book, 7.5% ROE. Fast forward to today. We're down to about 14 times earnings. Okay, much better. No longer a bubble. We're at about 2.25 times book. But the return on equity of an average Japanese company is just 8 or 8.5%. Now, there's all kinds of talk about Japanese companies rediscovering the need to increase profitability, returns, shareholder returns, etc. It has gotten better, but we're talking about ROE moving from 7 to 8 or 8.5, 9%. Still subperforming the rest of the world, making it difficult for a value investor to find value.
David, you've got an immense advantage that you're not on the left coast or the right coast. You're smack dab the legit flyover zone as well. What does Wall Street get wrong within the 3 zip codes in New York City? What's the number thing we get wrong about the American productivity experiment?
Well, first of all, I mean, quite clearly, there is a uniqueness about America. And this is why this is why we have a border crisis, folks, because people are fleeing command economic structures where they're economically oppressed, and they're going to economic freedom. We're not as free as we used to be, but we're still one of the most free from an economic perspective. It still is a land of opportunity. We still have huge upward mobility, and so people want to come here. And we don't even have the safety nets that, say, Europe has or Canada has. We have an opportunity society, and we do forget about this. It's not perfect by any means, but it's far better than any other place in the world.
David, I got to leave it there. David Herro, thank you so much. With a real look in there, as Paul mentioned, Germany, a real focus of his portfolio. Mr. Herro is Deputy Chairman, Chief Investment Officer, International Equities, Harris Associates.